In America, credit plays such a major role in our economy that if we aren't aware of how to manage our credit, we will unknowingly lose thousands of dollars and put ourselves in a much worse situation than we need to be in. The difference between 4 and 5% on a 30-year fixed mortgage on a $225,000 house goes from $1,074 monthly to $1,208 monthly for the same exact house. Literally no extra value to you, but it's an extra $134 per month, which over 30 years turns out to be $48,240. Do you see why credit is so important? Credit score is just the number that shows how reliable a person is to pay back their loans. The higher your credit score, the lower interest you have to pay to borrow money. So here are the 7 factors to consider for building your credit. Number 1 is your age of credit history, or the average age of all of your lines of credit. Number 2 is payment history. This makes up 1/3 of your score, so do everything possible to make at least your minimum payment to not get any late charges. For some banks, if you pay half of your minimum payment 15 days before it's due, and then the remainder 3 days before it's due, it throws off their 30-day payment cycle and shows up on your credit as making 2 full payments, thus boosting your score. Number 3 is number and variety of your accounts. Various types of loans will count differently. There are auto loans, home loans, credit cards, student loans, and any personal lines of credit. Auto loans are known as installment loans, while credit cards are known as revolving debt. The difference is that installments are a fixed payment, so it doesn't matter how much you owe left compared to the total amount borrowed, while revolving loans go off of how much debt is still left unpaid. If possible, try to pay off your credit cards each month to avoid interest. And ideally only have a few credit cards and do not get department store credit cards. Number 4 is credit utilization. How much available credit do you have compared to how much you are currently using? In order to consistently grow your credit, keep your credit cards below 30%. If you are below 30% utilization, you can call your credit card companies and sometimes get a credit increase, which can boost your score. Be aware, some companies will do a hard check when others won't. If you do have debt, consider refinancing your loans to get a better interest rate and lower monthly payments, thus more monthly cash flow. Companies like Credible have interest rates as low as 4.99%. Number 5 is derogatory marks, which are any missed payments or anything else negatively affecting your score. Number 6 is hard inquiries. These can stay on your record for up to 2 years, and most inquiries negatively impact your score, so please check first before you apply for anything. And be careful, the ideal number of inquiries is 1 or 2 per year. And number 7 is debt to income, and this is the biggest factor for qualifying for a loan next to your credit score. Creditors do the same income and expense analysis that we did earlier this section in order to see if you pay your bills on time. The lower the debt to income you have, the higher chances of getting a loan, as well as higher loan amounts. For those with a remaining balance every month, getting out of debt will create the biggest amount of extra cash flow, so please focus on this before investing. There are 2 main ways of getting out of debt: the logical way and the Ramsey way. The logical way is pretty straight up. Each credit card or other debt you have will have a minimum balance and a total remaining balance due. Look at each of your debts and determine which one drags your cash flow the most in comparison to its relative balance. Let's say you have 2 different cards, one with a balance of $3,000 and a minimum payment of $40, and the other card with a balance of $5,000 with a $100 minimum payment. Which should you pay off first? An easy way to check which one is the least efficient is by dividing the total balance by the minimum payment, with whichever one ending as the lower number being the worst loan to have. 5,000 divided by 100 is 50, when 3,000 divided by 40 is only 75. In this case, the $100 for the $5,000 loan is more of a cash flow drag for how much is being borrowed, so it will give you the greatest return once it's paid off. The Ramsey Way is named after Dave Ramsey. He's one of the most well-known debt removal advisors in the field. He is known for handling the runaway train cases where his clients just can't stay out of debt. This is why he almost always recommends cutting up the credit card after it's paid off so there's no temptation. He says even though it makes sense to pay off credit cards that are dragging your cash flow the most, it never made sense to get in debt in the first place. Logic is hard sometimes because a lot of our actions are based on emotion. Instead, he recommends paying off the card with the smallest balance first, even though it's a little more interest over the long run. The main reason Dave is such an advocate of this approach is that not only it creates cash flow sooner, but more importantly, it shows a win and it gives a feeling of accomplishment in creating more motivation to tackle the other cards. No matter what option you choose, actively pulling yourself out of debt will be tough, yet it'll be so rewarding once you are done. The best advice for someone with no credit at all is to go to a Discover Bank or other large banking institution and open what's called a secured credit line. All you have to do is open a savings account for the same value as the line of credit you want. We recommend the lowest amount of $200 or $300. Use this card only for gas or food, and this keeps the balance low so you can always pay from that savings account and pay it well before the due date. There's no reason to pay extra interest, especially at this stage. You have to keep this account open for at least a year, so not only will your habits around money improve, so will your credit. So even if you don't have any established credit, the average credit score increase from people who have done this is over 100 points. If you already have good credit and little to no revolving debt, there are a couple of ways you can utilize it right now. Number one, you have the choice as far as good rewards for credit cards. So as long as you pay off your full balance every month, you can actually earn a return from using your credit cards intelligently. Number two is in today's market, you can even make a passive income from selling access to your trade lines. People with bad credit can become an authorized user without having access to your card, so they benefit by showing that they have good credit history, and you benefit from a stable cash flow every month. If you are interested in finding out more information about this, go to splendidcredit.com. The main reason you should want to build your credit is to set yourself up for the future. The next section is all about investments, and having a strong credit score will only make investing easier.